So the other thing is, Akhil, Motilal is perceived as equity specialist.
Yes.
Right from day one, the way it has been positioned. Of course, performance keeps going up, changing. It's a function of the markets, and there are different styles. So we have also built up our own proprietary based in-house framework in which we look at that. Sometimes what happens is people look at diversification, and let's say they allocate 50 lakhs to Motilal, 50 lakhs to somebody else at some days. They don't look at the style, and they allocate money basis the brand names. So that's what it happens in PMS industry. Now, if somebody is following, like Motilal is following GARP methodology in terms of investing, and somebody else is also following the same, then it is not a diversification, it is actually a duplication. Now, take your opinion on how important the style is, number one, when you are managing public money. And number two is, can you also talk about, like in last 1 year, value started doing well, growth stocks are not doing well, and there are contrarians in the markets who are saying that they will have a different opinion. So because you are equity specialist and you look at all different different style of investments, can you talk to us about that and throw some more lights to enlighten our investors?
Yes. So essentially, there are two styles of investing. There is value style of investing. There is growth style of investing, right? Depending on managers' capability, they choose their style and they follow it. What do you mean by value style is basically buying stocks with a higher margin of safety, low PE multiple. So, and you're trying to play on the future growth, right? The growth will come. It is not there today, and therefore the valuations are lower. So you buy and you wait. So that's called value investing.
Right.
Growth investing is when you're trying to participate in the current growth. So where you are finding companies which are growing today and likely to grow for several years to come. So that's the basic difference between value and growth. Because in growth style you are buying into today's growth, the valuations are slightly higher than somebody who is trying to buy tomorrow's growth, so the valuations are cheaper.
Right.
Both styles are equally important. At different points of time, different styles will work, different philosophies will work. Like you rightly said, in an investor's portfolio, both styles combination should be there. That is the asset allocation.
They should complement each other.
They have to complement each other. You cannot be that you are 100% growth or 100% value. It has to be a good mix depending on your risk appetite, right? Now, as you rightly said, we are growth investors. So therefore, we are participating in today's growth. And our style, GARP is one way of putting it. We call it QGLP. So high quality, high growth at reasonable price. Quality aspect of the market has been underperforming for some time now. We are on to our philosophy. So if you see, the quality orientation of the portfolio is extremely high, right? Growth is there, valuations are low, but valuations are low because quality has underperformed, let's say relatively low quality stocks, right? So that is one source of underperformance which is coming from the growth investors, number one. Number two, more specifically in last 1 year, and we have seen this in 2018-19 as well, where markets are going in a different trend and active investors are going on a different trend. Like I told you, that most active managers will invest in quality because rule number one for active investors is to manage risk, ensure that you don't lose money. So quality orientation will be paramount, will be on top of any active fund manager. Markets don't think that way. So when you buy index, you will find high quality, low quality, you will find everything over there. In last 1 year, more specifically, we have seen that 80% of the returns from the benchmark has come from public sector banks. Within public sector banks, the mid-sized public sector banks have done phenomenally well out of the blue, right? Followed by your CPSE index, followed by the metal index. Now, these three components have produced 80% of the return. Right? And these three are very, very cyclical in nature. Quality orientation is absolutely not on the top, which is where, if you see any active manager, the allocation to these three sectors either is zero or under allocated, right? Which is where the underperformance is coming from, because what you are not owning is flying and what you are owning is actually flat to getting corrected, and there is where the source of underperformance vis-a-vis the benchmark is coming. Now these scenarios will come from time to time, And at that point of time, one has to relax, not purely look at underperformance and outperformance in short, medium term. Look at the underlying portfolio, chase the growth, chase companies' earnings, and from there one should get the conviction that in long term, if the fundamentals of the active managed portfolio is better than the passive portfolios, then the outperformance will certainly catch up. But from time to time, you will see that this kind of situation will happen. In 2018-19, if you remember, markets were very polarized towards 15 stocks.
15 stocks.
Your Reliance Industries, Twin HDFC, and
Bajaj.
Twin Bajaj. Now, if you are under allocated or not allocated, then there is an underperformance.
Right.
So investors, through your platform, I would say that in these situations, when you see underperformance, try and understand the source of underperformance. If the underperformance is not fundamental, then one should not panic and one should have the long-term orientation. And yes, if you feel that fundamentals are not in place, then one needs to take a call in terms of rebalancing. So last 1 year has been very, very challenging for most of the active managers, I would say. But that is also creating an opportunity for value investors.
Right.
Not in the typical way, but most active funds, because of the underperformance, are now looking.
So growth is become value now.
Yeah, growth has become value.
Okay.
So this is the best time to buy growth at the right price.
Right.
Growth at reasonable price. That's the GAP formula.
Great. Well said.
I think in long term, certainly, what I see in our portfolios, our portfolio earnings growth is far better than the benchmark earnings growth. Our quality orientation measured through return on equity is far better than the index, and our PE multiples are far lower than the benchmark. Now we have put the matrix in place. We have to wait for the markets to give us our due, and that is where you will see phenomenal outperformance.
Major alpha would start coming.
Yes.